So coming back, we're going to go through some of the cost flow assumptions used to account for inventory. So as I mentioned, this is your LIFO, FIFO, weighted average costing that you've probably been somewhat exposed to in the past. We're going to do a quick review of it. So which cost flow assumptions do companies choose to adopt? So there's specific identification. Specific identification is the only one that is tied specifically to the item and the cost. It is exact. If I buy, let's say I buy a fishing reel for $5, I'm going to sell it for $10. That'd be a very, very cheap fishing reel. I know exactly which fishing reel I bought for $5, and when I sell that specific fishing reel, I am going to record the $5 as the cost of goods sold for it, because it's specifically identified. This is very typical for cars, where you have cars that are marked by a VIN number. They are accounted for on specific identification. When that car is bought by the dealership, a specific amount is recorded as the cost of that specific car. And then when it is sold, there is revenue with that specific car. They're matched to the costs, and that's how it works. That's specific identification. Now, that is the only one, that is the only cost flow assumption that actually matches the flow of goods. All the rest are assumptions about the flow of goods. They are not intended to match the flow at all. As a matter of fact, the flow does not matter. I don't care if you use FIFO, but the flow matches LIFO. It does not matter. So these are assumptions that we make from a costing standpoint. It has nothing to do with the physical flow of the goods. So the other methods are FIFO, LIFO, and average costing. Under a FIFO method, that is first in, first out. So the first inventory items or the first costs that I incurred are the first ones that I applied to my sales. So if on January 1st, I bought a fishing reel, I bought fishing reels for $10. And let's say I start a company, the first fishing reels I bought were for $10 in January, and let's say I bought more for $20 in February. When I make a sale in March, the first time I make a sale, I'm selling that $10 fishing reel, or the cost is going to be assumed to be the $10, the first one I bought. It doesn't matter from a flow standpoint. Maybe I sold the actual reel that was purchased in February for $20. It doesn't matter, especially if they're the same thing. I'm treating the cost as the first in is the first out. So the first cost I have is the first one I alleviate. Now that cost is gone, I move on to the next one. Now that's first in, first out. Under a LIFO is last in, first out, which means in the same example, when I sell a fishing reel in March, the last one in is the first one I'm selling. So it's the cost associated with the February reels. So it's the $20 costs that get applied under the LIFO method, because those are the last cost incurred. And then average costing is just exactly that. It takes the average. So I bought $10 reels in January, $20 reels in February. The average is 15. So when I make a sale in March, I just average, well, my costs on average were 15. That's what I apply as the costs. So those are the cost flow assumptions. Now, just remember, it does not need to match the physical flow of goods. So I'm going to walk through an illustration. So Car-Mart Inc. had the following transactions in its first month of operations. So it had some purchases, it had some sales, and that's what we got. So we're going to calculate goods available for sale. Now, remember, the goods available for sale aren't really going to matter at all in this case. So our beginning inventory at the beginning of March is 2,000 units at $4 a unit. So that is going to be $8,000. That's our beginning inventory. We had purchases over the course of the period. We had purchases 6,000 items at $440 and 2,000 items at $475. So those are our purchases for the month, which gives us a goods available for sale. Again, this is our periodic formula here. Our goods available for sale were $43,900. That's what we had available to sell this month. Now the question is, how much of that did we not sell? So how much is still sitting in the inventory? So under specific identification, we are going to specifically identify which items we sold, pull those costs, and that's what we're going to apply. Practically speaking, what we do is we say what's left in inventory. What are the specific costs associated with what's left in inventory? If it's not left in inventory, then it's obviously a cost of goods sold under our periodic system. So let's walk through that. So we count our ending inventory and we find that our ending inventory of 6,000 units consists of 1,000 from our March 2nd purchase, 3,000 from our March 15th purchase, and 2,000 from our March 30th purchase. Okay, well, we know the costs associated with each one of those purchases. So we have our number of units of 1,000 on March 2nd at $4, 3,000 on March 15th at $4.40, and 2,000 units purchased on March 30 for $4.75. The total cost of those units. So our ending inventory of those 6,000 units, the total cost is actually $26,700. That is the ending inventory. Now, if we want to calculate the cost of goods sold, we take our goods available for sale, subtract out our ending inventory of $26,700, which gives us goods available for sale of $17,200. So that is how that calculation works, using a specific identification, and how the periodic system kind of works there towards the end, as we saw. Now, if we took average costing, so average costing just takes the average cost of all the items we purchased during this period, average cost of whatever the beginning inventory, averaging out all across all of our units, and that is the value we assign to the units sitting in ending inventory. So we know how many units and the cost of each of those. We extend it out. So our total cost for the period were $43,900. $43,900 was our total cost. Well, we bought 10,000 units for $43,900, so our average cost is $4.39. That is our average cost. Well, we have 6,000 units still sitting in inventory times $4.39 gives us a value or cost of goods in inventory of $26,340. That is the ending inventory cost. We take that out of our goods available for sale, which was $43,900, which gives us cost of goods sold at the for this period of $17,560. So that's the average cost method. It's weighted average cost method because we are weighting the cost by the number of units that we purchased of those costs. So now average costing changes if we're doing, say, perpetual versus periodic. What we just did was a periodic system. Now, a perpetual system would actually give us something different because halfway through the month on March 19th, we actually made sales. So the average cost when we made those sales is different than it is at the end of the month after we purchase more items. So in that case, we need to figure out, well, what's the average cost at the time of the sale, which is actually $4.30. We multiply that times the items sold, which gives us a cost of goods sold, which is different than if we do it under the periodic system at the end of the month after we've bought more items. So that is how that changes, whether we're using the periodic or the perpetual system. Again, perpetual system is very rare because this is pretty burdensome to actually run this every single time you make a sale, which can be multiple times a day, thousands and millions of times a day, depending on who you are. So that's our average costing or weighted average costing method. Now, if we move on to our first in, first out, or FIFO method, this assumes goods are used in the order in which they are purchased. So the first items that I purchase are going to be the first items that I'm selling. And so the ending inventory, which is what we're looking at, are actually the last items purchased. That's critical. It's called first in, first out, but what we really are interested in is what was the cost of the last items purchased, because we're calculating the ending inventory, not what flows out. So the first in, first out, those first items are what are gone. They're what ends up in cost of goods sold. But when we're calculating ending inventory, it's actually the last costs in there that are ending up in ending inventory. So if we work through our example using this, under our periodic system, we just work backwards. So on March 30th, we had purchased 2,000 units at a cost of $4.75. So those units are still sitting in ending inventory. Remember, it's the last units purchased that are now sitting in ending inventory because the first units were the first ones to flow out. And we're trying to calculate inventory. Don't flip this around. That's a very common error, common mistake. So we had, of the 6,000 units in ending inventory, 2,000 of them were purchased on March 30th. We need another 4,000. Well, 4,000 were purchased on March 15th at $4.40. We extend our costs over, which gives us, for our 6,000 units, a total cost of $27,100. That is our cost of inventory left over at the end of the period. Now, we deduct that from our goods available for sale to give us cost of goods sold of $16,800. Under a perpetual system, nothing changes for FIFO. It's the exact same as it is under a periodic system because the first items being sold are going to always be the same unless you can sell goods that you didn't buy, which is not possible. So because of that, you're always going to be selling the first items first, regardless of whether you figure that out in the middle of the month or the end of the month or whatever. So under a perpetual system, you're always doing FIFO. Now, under FIFO, it doesn't change whether you're using perpetual or periodic. However, it does under LIFO, which we'll see here in a minute. So moving on to LIFO, or last in, first out. So under LIFO, last in, first out, the last items we purchased are the ones we're going to sell first. The last ones in are the first ones out. So that means that the ending inventory is going to be the first items that we purchased. Now, this is going to seem weird, and we'll talk a little bit more about some of the problems that this can kind of cause going forward. Because if you have a company that's been around for 50 years, they bought inventory 50 years ago. That inventory could still be sitting on their books as inventory at whatever cost it was 50 years ago, which is not likely the same as what it is today. So that's because the first inventory that was ever purchased is what's sitting in ending inventory, because the last inventory that was purchased is always sold every period. So what that ends up looking like. So we start with, well, if last in, first out, that means our ending inventory is going to be our first purchases, which is going to be our March 2nd of 2,000 units and our March 15th of 4,000 units. So if we extend out those costs, we get a total inventory cost of $25,600. We take that out of goods available for sale, which gives us cost of goods sold of $18,300 under the LIFO method. Now, as I mentioned, under LIFO, the perpetual inventory system gives you a different number because the last items purchased varies whether you're selling them in the middle of the month or at the end of the month, or whether you're doing it perpetually, or whether you do it periodically, say at the end of every period. So because of that, it's actually going to change. So in our March 19th sale under the perpetual system, that sale is going to be selling the units we just bought on March 15th first, whereas when we waited under the periodic system, the stuff we sold was the March 30 items, which technically at the time of the sale we didn't even have purchased those items, but that is not critical from an accounting standpoint. So this changes. So what we end up with is a very different number under the perpetual inventory system using LIFO than under the periodic system using LIFO. So those are our main inventory systems. We're now going to move on and talk a little bit about some of our LIFO and other inventory issues.